Welcome everyone to the Mastering Stock Market Trading course. If you guys don't know who I am, my name is David Eves, longtime day trader and YouTuber. And in this course, we're gonna be going over pretty much every single thing you could possibly need to begin day trading, swing trading, or even just long-term investing. I'm talking everything from how the stock market works, to indicators, to the psychology behind trading. So by the end of this course, you guys should be pretty well equipped to begin day trading, swing trading, or really whatever style of trading it is that you want to adopt. And at the end of the course, there's gonna be a few live trading examples just so I can show off some of the things that I'm telling you guys and showing you guys within the course. That way you guys can get a better idea of how to go ahead and begin yourself. And what it is that I look for when I am day trading is that's what I generally do is day trade, but a lot of the things will apply to swing trading or any other forms of trading. So with all that being said, I hope you guys do decide to enroll in the course and become a master of stock market trading. And with all that being said, I will catch you guys inside the course. Welcome back to this lesson where we're going to be going over how to use the TD Ameritrade Thinkorswim platform. So when you guys first load up the software, this is what you're going to see. If you go up here, you guys can actually take a look at your multiple accounts. We're currently in my retirement account. I'm just using this for the example. But if you guys go ahead and look, you're not really going to want to worry about this screen. This is just kind of the home screen. You can go ahead and watch the TD Ameritrade network. As well as CNBC, all these different stations. You can watch that if you want. It'll give you a countdown to when the markets close. It'll give you an overall here, current positions and things like that. I currently have not traded anything today, but you can also go ahead and add some widgets, and it gives you this information down here. But as of right now, I don't generally use this. I'm almost always going to be on this section. So if we look here, we're going to see all of these charts. I generally will be trading natural gas. So I'll have mine set up like this, and on the top sections, I have the futures, and on the bottom sections, I have the actual ETFs. So in this case, UGAS is the bull ETF, DGAS would be the bear ETF. But what I like to do is go ahead and start up my watch list over here. By default, I just have these two default lists set up, and then I can go ahead and click in personal and switch it over to some of my other lists, some of them being quite large, some of them being smaller. But for the purpose of this video, we're just gonna keep it on default. I have these actual watch lists tagged, and what this does is basically I can put red on this, and then I can put red on this, and now if I click on Tesla, it's gonna go straight to Tesla automatically by me just clicking on this. So that's how you do that with these little tags. You can obviously use more tags. Red's pretty much the only thing I ever use. But anyway, after this, if you guys want to get 4 screens like this, you guys can click up here. This is going to give you the 4 screen waffle cone options. You can actually get like pretty much as many screens as you want. I mean, I could do this, right? That being said, I don't really have any interest in doing that. I generally keep it on 4 here. And then the flexible grid, you can actually also add more screens here. It's a little bit more difficult. You have to go, let's see, here and click customize, and you can add one. I don't really use that. I generally will keep the flexible grid just on one default thing. That way I can do more technical analysis on a singular chart rather than having to look through a tiny chart on here. So that's generally what I do with the flex grid, is just keep that as kind of my big chart, and then have the regular charts as my 4 charts that I'm kind of looking at all times. But you guys are probably wondering how exactly I got the software to look like this. So I'm going to go ahead and go into my settings, just because the general default charts don't actually look like this. They actually probably have a grid. They look entirely different and things like that. So first off, we're going to go into the settings, and I'm going to let you guys just go ahead and you can pause the video and look at this and actually just copy these if you want, just because I'm not entirely sure exactly what's changed and what's not from the default. So just go ahead and take a look here. This is also just my preferred settings. You guys can obviously keep them how you want. But I know the default definitely under one of these has a almost grid going in the background. I'm really not a fan of the grid, so I actually take that off. It's somewhere in here, but these are all the settings that I have. So I'm just going to slowly go through these, and you guys can go ahead and copy them if you would like. And here's this grid section. If I go ahead and click this and click apply, you guys will see this grid in the background. That's how it is by default. I'm not a huge fan of that, so I always keep it off. I just like to see a plain gray background, but you can obviously go in here and change the background to some crazy things if you wanted. But I don't really have a big interest in doing that, so I kind of keep it here. You can do black. You can do a lot of things. The overall program is very customizable, but for the most part, I keep a lot of things kind of default. You can also take a look at all of these things. options, I will trade those here and there. And then futures and Forex, I don't really think I've done anything with, but you can take a look in case I have. But I'm pretty sure I've not done anything with these. Once you're done with all that, you can go ahead and click OK, and it will pretty much look like this for the most part. Now, at this point, you probably don't have all of these lines and things like this, though. You also probably don't have this in the bottom. So I'm going to go ahead and show you guys how to get that. Now, I want you to keep in mind that on this chart, I have the RSI down here, but if you guys look at my actual regular charts, I don't, just because it's a lot of stuff to put in one place, and I don't generally use the RSI nearly as much as the MACD, so if I ever do need to take a look at the RSI, I'll just throw it in here and then look at it on this chart since it's already pulled up here. But you could go ahead and add the RSI to these charts as well if you wanted. It's a little bit of a pain because I believe you actually have to go through all of these and individually add all of these settings that I just showed you, but it is worth it in my opinion after the long haul, and you can actually save it so that it will stay like that once you have it done. So in order to get all of these lines and studies and things like that that you see, we're going to talk about these in a later video, but in order to go ahead and get these, you want to click right here at this little beaker, I believe, and you can just go ahead and copy what I have here just by searching up the name, and these in the parentheses are the settings for each one of these. I generally will always have the 180-day simple moving average as well as the MACD on the default settings, and then the VWAP on the default setting. The exponential moving average I will definitely change here and there just depending on what's going on, but for the most part 10 is probably going to be fine. I don't use that a ton either, so. And you can actually go ahead and save these as a set. So I have a default set, I believe. Let's see. Yes, I have main, and then I have main no VWAP. So I'm not going to save this as I already have this done. But once you guys do have this set up, you can go ahead and save this. And then all you have to do is click right here and click use set, and it will just work. And then you don't have to go in and actually change stuff every single time you restart the program or something like that. And if you were to get it on another computer, you guys will still have those options saved, so you can just go ahead and click real quick and it'll show up quick and easy. Now, once you've done that, I highly recommend going up here to setup and clicking on application settings, and also under look and feel. The reason mine looks like this also is because I have the old school TOS color scheme set up. If you guys are just getting the program, you're probably just on dark. So if you did want it to look like this, you can go ahead and put old school TOS on it, or you can just keep it how it is. That's completely up to you. It's just cosmetic. But after this, I'd go ahead and click apply settings. And then what you also want to do is go back up here and click save workspace as. So mine is already titled default. That is what I named my default workspace. And whenever I get this program on a new computer, or even when I load it back up, it will automatically open under default and have all my stuff already saved correctly. So that's pretty much how you use the software in terms of actual trading. Now, obviously, there's some more stuff you can do up here. So if we were looking at Tesla stock, for example, we can go up here to analyze, and you can look at a lot of fundamental data here, like earnings and things like that from the last 4 or 5 years. And for a lot of companies, you can come down here and it will actually give you a division estimates and things like that, and kind of give you a good idea of what people are valuing the company at in terms of analysts and things like that. Obviously, Tesla is far higher than this right now, so analysts aren't exactly. So currently, Tesla is much higher than what analysts are estimating, but that is here for you to take a look at. If something's way above what analysts are estimating, then you might want to not invest in that just because it could be overvalued, or certainly look into it much more than you would otherwise. But this will kind of give you a good idea of a lot of things that they do and tell you about a company. Obviously Tesla is something that you know a lot about, but if we were to go pick up some random company like Baidu or something, you might not know what that is. And you could come in here and take a look and see what this company does, why they may or may not be a good investment. And of course up here you do have some economic data and probability analysis and things like that. I generally don't use these tools, but they are here if that's something you're interested in doing. And if you guys want to trade options, this is where you're going to want to go to trade and click on all products, and it will basically give you the options contracts. So if I wanted to trade the 21st of February's Tesla contracts, I would go ahead and click here, and I have the calls on this side, the puts on this side, and I can go up to spread and it'll create me automatic spreads here. So it's pretty simple to use. And you can actually also copy this. So copy, and this is actually the contract that I just picked. This is the graph of that contract. And as we'll also talk about in a future video, level 2 is here. If you just click this, it'll show up And you can also, I like to keep time and sales on when I'm on the flexible grid. So I have time and sales over here. You can cut that off just by clicking here, but and then level 2 is here. I usually will keep this off for the most part unless I'm actually in a trade and I want to get an idea of where I want to be setting my orders, as we'll speak about in another future video. But there are a lot of other things. When I do have an open trade, I'll also often open active trader just because it will tell me my current profit loss based on current prices. And as for actually trading, the last and most important thing is going to be how to actually execute an order. So if I want to go ahead and click buy on DGAS, I'm going to right click buy, and it's going to go ahead and give me a default order of 100 shares. Obviously, I don't want to trade 100 shares of this, so I can click edit and I can pretty much change this to whatever I want. So maybe I want 5 shares, and then I can click confirm and send. Now, obviously, I don't want to go ahead and purchase this right now, especially in my retirement account, but at the end of the day, that is what you would go ahead and do. So I'm going to go ahead and click delete on that. And once you are actually in a trade, it will show you on the active trader. It will tell you your profit loss for the day, as well as your overall position size and average price. And if you wanted to get out of that trade, you guys could right click above and click sell, edit. And a cool tool here is to actually just go ahead and click right here, and you can put 100%, and that'll just sell the entire position that you currently have automatically. Go ahead and click confirm and send. And once you guys have a trade, you can also, it'll show up with a line right here. I don't know how to really explain that right this second. I guess I could go ahead and click this, and let's do 1 share. So my buy order is right here, and if DGAS were to ever go down to here, I would get filled. It works the opposite. There will be a red line that looks just like this up here, and if it ever gets up to here, it will go ahead and get filled. Now, TD Ameritrade is a little weird about OCO brackets. It doesn't entirely work right, so I usually like to click buy custom with OCO bracket, but some of these, it might take a little while just to actually learn how to do this. I don't generally use a lot of OCO brackets, so it's not a big deal for me, but that is here if you wanted to use that. And the software will glitch out here and there and not edit things when you go ahead and tell it to do so, and you have to go in and manually do it. And it's a real pain, but at the end of the day, that is how you do an OCO bracket if that's what you want to do. And you can also, when you go ahead and create an order, if you wanted to buy, when you click edit, you can actually go ahead and change the price here. You can see whether or not it's going to get filled or the likelihood of it getting filled, as well as changing the actual side, as well as the order type if we were looking right here. So you could go ahead and make a market, you can make an OCO brackets, you can make a lot of things like that. So if you want to make a stop, that's how it works. So it's pretty simple once you get the hang of it, and you guys will have a better idea of the program once you watch the live trading examples at the end of the course. But that's pretty much TD Ameritrade's Thinkorswim platform. Obviously, you can use another broker, but I don't have a ton of experience with too many other brokers, and therefore it wouldn't really be of much value for me to go ahead and make a video showing you how to use the software, as I really just don't know how to use any other software than this for the most part. So that's pretty much it. One last thing, there is a cool feature that TD Ameritrade offers called On Demand. So if I click here, this will actually open up like a paper trading account, and I can go here and set the date to whatever I want. So February 27th at 9:30 a.m. 2019, so that's about a year ago. And I can actually sit here and fast forward through the market, and I can take trades and really play with the market. Now, I will say this is a great tool to practice with, but if you use it for a while, you will figure out that the fills on it are just wrong. It will actually just show up, like I could put an order like right here, and it'll fill me sometimes. And all of a sudden, I'm filled right here, even though the market's up here, and I'm like, $200 in the green, when in reality that would not have happened if you were live trading. So just keep that in mind when it comes to actually trading, and you'll be fine. But that definitely can be a great tool to go ahead and use. So I think I've pretty much covered everything that you need to know to go ahead and get started and become familiar with the software. You're definitely going to want to play around with it a little bit here and there just to become more familiar with it yourself. And so with all that being said, I will catch you guys in the next lesson. All right, so in this lesson, we're gonna be talking about penny stocks. You guys have probably heard of Timothy Sykes or someone like that who are big penny stock promoters. I'm not a huge fan of those people, but penny stocks are what people think of when they think of day trading in a lot of cases. It's a very popular thing to attempt to trade just because, Apple, if Apple goes up 10% in one day, that's a absolute huge day for Apple, and that probably only happens 2-3 times every 4 or 5 years. Whereas if you guys have watched The Wolf of Wall Street, this is a fictional company, but Aerotyne International, that's what Jordan in the movie was talking about. Aerotyne, it's only worth, $37 million, and they just got a huge contract for $5 million. Aerotyne might go up 20% today, and next month they might go up again, or they might go down. So penny stocks are generally going to be much more volatile than blue chip stocks like Apple or Facebook or Google or really any of those companies, which is going to allow you guys to profit much more from these companies if you are able to successfully trade these. Now, if you read Timothy Sykes' book, he's actually made most of his money from trading penny stocks, but he was mostly swing trading. He was buying positions and sometimes holding them 2-3 months, kind of based on hunches back in the 90s, and that's really something you could do back then, but it's much harder to do now. It's not as if you can't do it, but he was buying a lot of healthcare companies that he knew they were working on something, and an announcement of some likely success was probable in the near future, and he'd have $10,000, $20,000 invested in that company. All of a sudden, a company like Pfizer comes out with Viagra, something that revolutionizes the industry, and all of a sudden, this company went from $30 million to being worth $300 million like that, and all of a sudden, Timothy Sykes' position goes from $40,000 to $400,000. So it wasn't as if he was just day trading constantly and doing things like that. He really took advantage of news and potential opportunities, which is something that's definitely a little bit harder to do nowadays than it was back when he first started trading. Not to say you can't do this, but overall speaking, penny stocks are going to pose much more risk, and with that, much more reward than if you were trading blue chip stocks or some commodity based ETFs or things like that, where you might make 2-3% in a day if that was a good day, in comparison to penny stocks where every 2 months you might make 100% on something, or even sometimes in single days you can make 40-50%, but you could also lose 40 or 50% tomorrow as well. So just keep in mind that penny stocks are much more volatile than pretty much anything else on the market aside from options. And if you guys are making money, then that's great. You're probably making a ton of money doing it. But if you guys are losing money, you're probably losing a ton of money doing it. So with all that being said, I will catch you guys in the next lesson.
What's going on, everyone? Welcome back to another lesson, where in this lesson we're going to be talking about pump and dumps. So if you guys have ever seen The Wolf of Wall Street, then you guys probably have a decent understanding of what pump and dumps are. They explain it pretty well in the movie, but it's basically where somebody essentially buys up a large portion of a stock, and then they pitch it to a lot of other investors. They get a lot of hype around it. Oftentimes there's going to be bogus news stories about it down here. How this company, has the opportunity to make trillions of dollars and they're the next Amazon, when in reality they're a penny stock that's worth pretty much nothing. I took the liberty to do a small scan here where I got a few companies that may be pump and dumps. Now, I will say, just sitting here looking at this last one that I was looking at, this is actually probably not a pump and dump, as this is Richard Branson's Virgin Galactic. However, this is very much so what a pump and dump will look like in terms of a stock graph, and how you can recognize when something may be being manipulated. And even if it's not being manipulated, if a graph looks like this, in this case, Virgin Galactic is probably not being manipulated. But even a stock case like this, I wouldn't invest in it for the same reason. And the reason for that is, for months, this stock was trading at almost nothing, $10 a share, and it was going up on average, 0.5% a day, give or take, maybe 1% on a big day. Here, over the course of 2 days, we had 1.6%. And all of a sudden we have a big shoot down, and then it shoots way up, and we're up almost 300% from its low just 2 months ago. So, this is what a pump and dump will look like oftentimes. I honestly was not able to find some really good examples, although I do have a few in mind. So in this case, this showed up on my scan here, although I will say this is definitely not a pump and dump. They just had a good earnings call, and that's why they had a big shoot up, and that's why it met the criteria of my scan. But if we look here, this is a $400 million company. That's definitely possible, especially here. If you look at these blue graphs, these are the volume charts. Every time we have an earnings call, like here and here, and here, a lot of times you will see more volume going through. But then all of a sudden, out of nowhere, no earnings call or anything, we have one of the highest volume days ever, and the stock is up almost 20% in just one day. So I'd really question what's causing that. It's probably something to do with news. In this case, Canopy, which is one of the largest weed companies, actually had a very good day, and I'm pretty sure this is a weed company as well, and it's likely that they benefited from Canopy's large day, and that's part of the reason there's more volume here. So a lot of times things can be explained, and maybe there isn't a guy like Jordan Belfort behind the scenes pumping something up and manipulating it. But even if the graph looks like a pump and dump, you probably don't want to mess with it, really for the same reasons. Just because someone is pumping it up behind the scenes doesn't mean you can't make money off of something, and it doesn't mean you can't lose money off of something. And it works the same way if someone's not really manipulating it at all, but it's shooting way up at times and it's really unrealistic. So if we look at this last company, this is very likely a pump and dump. Here, we'll type this in. Yeah, so, this is a very good way to realize what a pump and dump is if we look down here, there's really no volume. Here and there, there'll be volume, and then all of a sudden shoots way up. This is days after earnings. All of a sudden, we have a huge volume spike, shoots up almost 100%. So I would very much say this is likely a pump and dump, and there is some manipulation going on with this, especially here. I mean, look at this. All of a sudden, huge volume spike, huge price spike by over 100%, and then the next day it shoots right back down. So, it's not something I would invest in, just because you don't want to have a case of FOMO, which is fear of missing out, where, this company, if you're trading it intraday and it's up, let's go to the 4-hour chart. You're trading it intraday and it's up, 20% here. You don't want to be like, oh man, it could go up another 30%. It definitely can go up another 30%. But at the same time, tomorrow it could go all the way back down. So, if you invest up here because you think it's going to keep on going higher and higher, then, you just lost 40%, in one day. So that's really the main reason that you don't want to mess with pump and dumps. Here we have one of the most famous pump and dumps that I've ever heard of, really, and that is Helios and Matheson, HMNY. This has really been a big pump and dump ever since I ever started investing in the stock market. Here we are all the way back in early 2018. The company's trading at like almost nothing. And then we have a huge shoot up by 1,300%. Yet this is a week chart. By the next week, it was down almost 60%. So, you don't want to find yourself in a case of FOMO and buying up here when, this stock was literally trading at $9,000 a share, and yet today, or at least at the last trading day, it was trading at 0.00002 cents. So that represents a 99.99% loss. This is really the main reason you don't want to mess with pump and dumps. And the thing is, if you look right here at these volumes, we likely had a spike somewhere, but it's literally gone down so much in value that I can't even see the candle charts on this. So if we go back to the 180 day, back in September, all of a sudden, volume's really, really, really flat. There's no volume down here. The price isn't moving that much. All of a sudden, we have a huge shoot up in volume, and the stock goes up by over 400%. And yet, within 2 to 3 days, it goes back down over 60%. And, here, and over time, it's slowly gone back down to the same price of about 0.002 cents. And then here recently, it actually shot down even lower. This, I think, was not really manipulative. I believe the company may have announced some form of bankruptcy, or their main product was MoviePass. That was kind of what put them on the map and everything. And I think they're spinning off MoviePass, or they're selling MoviePass, or something like that. And that is likely what's caused this drop right here. So, that's probably not manipulation, but, if we look here, I would almost guarantee that this is some manipulation. If we go to a year chart, this is likely well, actually, that's the same thing. Here, okay, I can't even see it. So it's pretty much impossible to even see on this chart because it's just been manipulated so bad. And there's plenty of other examples. You guys may have heard of NIO. They're kind of like the Chinese Tesla. This is certainly not a manipulation case. This company has not been manipulated. It's actually a quite large company. However, there's a huge amount of hype over it, and it shot way up at the beginning, yet, over time it's gone way down. So, this is a company that was kind of hyped up for a little bit, and, nowadays it's really not got a lot of value on it. Could this company be worth something one day? Certainly so. Tesla's doing quite well now, but that's just something to keep in mind, that pretty much every day there's going to be some company that's just shooting up big time, And a lot of times there's going to be some level of manipulation. And even if there isn't manipulation, you probably still don't want to mess with it, just because you're going to have a chance of you trying to get in right here because you think it's going to keep on going up, yet it flatlines and then goes way back down again to far lower than what you were able to purchase the shares at in the first place. So whenever a stock chart looks like this, you probably don't want to mess with it. Now, if you're trading intraday, there definitely can be some potential here and there. I mean, if we go back a few days, there might have been a good day here. So, you might have seen some opportunity here when this touched the middle VWAP and you decided to purchase it and you made 3% on your money, in the course of an hour. That's not very bad at all. But in terms of swing trading, don't get caught onto the hype. And that's the exact reason that I don't really have a lot of Tesla shares right now, because I really see this as a lot of hype. And, while Tesla is a large company and there isn't any kind of manipulation going on with it, in my opinion, the stock chart still doesn't look incredibly favorable. And even though the fundamentals do, the stock chart just isn't there. It's shot up out of nowhere over the last little bit out of these two very good earnings. And, it's just not something I want to invest in, because I think it's very likely that Tesla is going to go back down to around 400 to 500, next earnings, if that doesn't work out incredibly well for them. And overall speaking, I definitely think I could get these shares at a much lower price. If I were to get into the position right now, I would consider that to be FOMO and, really just a overall mistake. So that's really what I wanted to highlight in this video. Is there's going to be companies pretty much every day that somebody's trying to tell you is going to be the next Amazon. It's pretty much always not true, and you really want to rely on yourself more so for what it is that you want to invest in, and you certainly don't want to invest into any of these penny stocks long-term speaking. Now, in the case of DGLY, if you wanted to trade this intraday, that could definitely be a great opportunity. If you were to purchase some shares in the pre-market, you could have made 50%. But in terms of long-term trading and holding this for, maybe a month, 2 months, because you think there's going to be a scenario like this again where you make 50%, it's probably not going to happen, and it's probably a pipe dream. So that's really what I wanted to highlight in this video. Is you probably want to stay away from any kind of stocks that have some level of manipulation or just very unrealistic movements. If you were to take the case of Tesla or Virgin Galactic. So overall speaking, I generally, if I'm going to be trading a stock, I'm likely going to be looking at something that I think is a overall good company and has some decent fundamentals. I might be trading Netflix tomorrow. That's a company that I think has some okay fundamentals. I'm definitely not as big of a fan of Netflix as I was in the past, but this is something I might be more inclined to trade rather than HMNY, for example, because if you're trading this, you're probably just asking to lose money. Especially even look at the intraday spread on this. It's literally 80% on individual seconds. So that's really what I wanted to highlight in this video. Is you probably want to stay away from low volume stocks like this and things that are gonna be very manipulative over time, because you're often not going to come out of that in the green. So with all that being said, I hope you guys did enjoy this lesson and you found a lot of value out of it, and I will catch you guys in the next lesson. All right, guys, so in this lesson, we're going to be talking about candlesticks and how you guys can read these and really what they mean, because it can be a little confusing as to what, all these individual things mean. So basically what this means is, so this is actually going to be a pretty quick lesson because it's actually very easy. It's just going to take me a second to go ahead and find an example. So in the case of this chart right here, if we look right here, we're going to see that this is a green candlestick. And what this essentially means is that it opened right here. It went all the way up to here within the day, and this is where it closed at. So if we were to look at this red one, that means it closed lower than it opened. So if we look here, the previous day it closed right here, it opened the next morning here, and it went as high as here throughout the day, but then it eventually went as low as here throughout the day, and it eventually closed at this price level within the day. So I'm trying to think of a way to better explain this, but it basically means, the little tail is as high as it went or as low as it went. And if it's green, then whatever it is at the top is where it closed, and whatever it is at the bottom is where it opened. Whereas if it is red, then wherever it is at the top is where it opened, and wherever it is at the bottom is where it closed. So that's pretty much candlesticks for you. There's not really a ton else I can say about them. I hope that explained it for you guys. If you guys have any other questions, I would honestly just recommend Googling or just looking at it on Investopedia. It's pretty self-explanatory, but it definitely can be a little confusing when you are just getting started, and that's why I went ahead and decided to make this video. Now, obviously, on the TD Ameritrade platform, you can go ahead and change the appearance, and instead of having candles, you could do like bars, and it pretty much looks like this. Kind of means the same thing. Anything higher than this bar is as high as it went. Anything lower is as low as it went. And, this is where it opened. This is where it closed. Sometimes these are a little bit easier to get used to when you're first starting. But overall speaking, I like the candle charts more. So that's what I generally will use. Now, intraday, you will sometimes see what we call a doji. And this is actually displayed in white, as we can see through our appearance. If we go look, doji is in white, and what this basically means is that it opened at this price point, it went as high as here throughout this time period, but it closed at the exact same price point. So minute to minute, it didn't actually move in terms of what it opened and closed at. So this is actually kind of important in terms of trading, because you'll actually see some of these sometimes in cases like this, and it can be a decent signal of a switch in direction, just because there's some indecision with traders. And this right here is a pretty good example, because we had a doji, little movement, and then we shot way back up throughout the day, nearly 0.5%. So they definitely can represent reversals in some cases, and we will go over that later on in the course. But that's what a doji is. And when it comes down to what each candle represents, that's up here. So in this case, I have the 1 day, 1 minute chart. So each one of these candles means 1 minute, and the whole time frame that I'm looking at is 1 day of trading. If I go to the 1 year, 1 day, each one of these candles represents 1 day, and the entire chart represents 1 year. So I can actually go here and change this to 3 years, and now we're looking, more data is here. Or I could go here and I could change, instead of a day, I could do 2 days. So now each stick represents 2 days of movement. So that's really how you can read candlesticks and how they work. And so with all that being said, I hope that was helpful and answered some kind of questions that you guys may have had. And I'll catch you guys in the next lesson. What's going on, guys? So I wanted to make this quick lesson to go over order types. I think I covered parts of it in other videos, but I do want to make a dedicated video just to go over the specifics of order types and when you may or may not want to use different orders. So if I were to want to purchase these shares at $336.2 on the TD Ameritrade software, I'm going to go ahead and click buy right here, and I'm going to go ahead and click edit. And by default, you're going to see a limit order, which means $336.21 is the most that you will possibly pay. You can obviously adjust this up and down, and that's really, what you're willing to pay at the most. So if you can get it for lower, the software will automatically fill it at a lower rate. That being said, this is kind of your max amount per share that you're willing to pay. When it comes to buying, if you guys were to click market, then it's just going to go ahead and purchase these shares at the current market price, whatever that is. The next order will be yours, or the next available order, as fast as they can put it in, will be yours. Due to technology, if you click a market order, you're going to get filled pretty much instantly in most cases, unless the volume is just incredibly low. And I'm not sure about TD Ameritrade, but I do know on Robinhood that market orders are really just limit orders that are set 5% above the current price. So in this case, it'd be way up here, and that essentially is going to guarantee that you get filled in most cases, unless something is very, very, very volatile. And then we have stops. You're not really going to use these too often when it comes to buying. These are more so sell orders. I really can't think of a single instance in which I've used a stop order for purchasing. It's usually closing a position. You will usually use a stop order if you do want to. Generally speaking, I just use limit orders everywhere, but every now and again it can be useful to have a stop order. And a stop order is basically going to sit where you set it. So if I were to set it to 336, then nothing's going to happen until it gets down to 336, at which point it will fill me. So it's really more so the lowest amount that you want your position to fall to. Is what a stop order is going to be used for in terms of selling. A stop limit order is essentially where you will set this at a certain price, and instead of it selling your shares, it will actually go ahead and buy shares based on a limit. So, if this were the limit, this is the maximum amount you're willing to pay, and the stop price that you set here is what's going to trigger that order to go ahead and get filled. And generally on TD Ameritrade, these orders are going to be linked, so just keep that in mind. A trailing stop is going to basically give you almost a percentage or a certain amount that as it goes up, it's actually going to follow and keep you, as your position rises in value, it's going to keep you at a certain percentage loss for the most part, or really a certain amount from the current highest price. So, if it goes up to here and you maximum want to lose 10 cents at a time, then you would set this to 10 cents. And if it were to go down, say you had sell, then it's going to follow that. So if it goes up to here, then all of a sudden your stop is now here rather than where it was just a second ago. That can be helpful in some cases. I don't generally use those. The trailing stop limit works the opposite way, generally on the buy side. And I've personally never used either of these orders. I'm not really sure what they even mean. I've never found a use case for them or ever been in a position in which I may want to use them, just partially because I don't know what they even mean. I've never even heard of them. In fact, I'm pretty sure these were not even on the TD Ameritrade software for quite some time, because I honestly don't recognize them. And I didn't recognize them until I just opened this up. So I wouldn't worry about those. Pretty much in all cases, a stop, a limit, or a market order is all you're going to be working with. Sometimes you'll use a trailing. But that's about all you're ever going to use. Limit is probably going to be 90-95% of your orders. The only time you're really going to be using a stop or a trailing stop or something like that is if you are intraday trading, but you're also preoccupied and you feel the need to go ahead and limit yourself in terms of risk, while you're not going to actually be able to sit here and watch the stock. But for the most part, limit orders are going to be your main thing. And if I were to set a limit order down here, then it obviously would be the maximum amount that I would pay, and the stock would have to reach this part before it would go ahead and get filled. That's on the buy side. And then if you were selling, the order would actually be up here, and that's basically the lowest amount that you'll take, meaning that if you currently own this position and the shares are here, it's not going to get filled until it gets to the price. So say you set that to 337 in this example, if it goes up to here, it's still not going to get filled. It's not going to get filled until it goes all the way up to 337. And then in most cases, unless it teeters there or something like that, then you'll definitely get filled. So that's pretty much everything you're going to need to know about orders. They're pretty self-explanatory in the most part, especially the market order. That's basically just going to go ahead and purchase those shares at the current market price. And then limit orders, that's primarily what you're going to be using just so you can limit your overall risk to the actual stock volatility within, intraday seconds and things like that. That's, of course, if you're day trading. If you're swing trading, then you're probably also going to use limit orders, but you're not going to be worried about individual seconds as much. So with all that being said, I hope you guys did get a lot of value out of this lesson, and I will see you guys in the next one. What's going on, guys? Welcome back to another lesson where we're going to be talking about level 2. Now, this can definitely be one of the most important lessons, while at the same time won't matter that much in the scheme of things. But it's also very simple to understand. So essentially what this is on TD Ameritrade, if you go over here to the right and you click this, you can enable it. And this is going to tell you what the current prices are on different exchanges. So if you're looking at futures, it's only going to give you one rate. So if we look at the natural gas future, there's only going to be one rate. But for the most part, if you're looking outside of that on any kind of equities or ETFs or anything like that, then you're going to see sometimes multiple exchanges. So if we take Microsoft, for example, these are the different exchanges that it is on, and these are the different prices at the different exchanges. And when it comes down to actually setting orders, there is a way that you can actually go ahead and set an order for a specific exchange. You're pretty much going to want to get filled at the cheapest or the highest price on either exchange. And what I mean by that is if you're buying, then you want to buy it at the lowest price, which in this case would be on this exchange. And if you are selling, you want to sell at the highest price, which in this case would be on this exchange. And this right here means that the orders that people are trying to buy this stock at are right here at these price points, and people are trying to sell on this side at the ask at these price points. So there's going to be a slight discrepancy between these prices. So people are trying to buy at 187.35. People are trying to sell at 187.70. The market price is generally going to be in between these two. So if you are selling, you're going to want to sell on this exchange. And if you are buying, you would ideally like to purchase on this exchange because this is the lowest price that people are willing to sell their shares for, and this is the highest price that people are willing to buy shares for. There's a lot of people who have the idea that you can actually look at, in real time and say, oh, there's a lot of sellers right now, very few buyers, and that means that the stock is going to go down. And on the opposite side, if there's a ton of buyers and there's few sellers, then the price is going to increase. This is somewhat true in intraday seconds and things like that, but that's not going to make a huge difference. But when it comes down to something like DGAS, this is something that'll have a large spread in which people are trying to sell shares at 235.50. People are trying to buy at 234.50. So there's an entire dollar spread here in where people are trying to buy and sell. And it's in cases like right here where there really is not a lot of orders going through, in which you really need to be able to see exactly where it is that people are buying and selling. That way you know, should I move my limit order up? Should I move it down? What should I do in order to get the best deal for myself? But on a lot of large companies, it's not going to make a difference just because it's going to be plotted very well here and there's not going to be as big of a spread. So on Tesla, there's not going to be a big spread. If the price is right here, that's probably where it's going to be selling at. So, it doesn't really come into handy that much when it comes down to large companies like Tesla or Facebook or Microsoft or any of these companies. But if you are trading some niche stock like DGAS or something like that, then you may want to go ahead and click over here and bring up level 2, just so you know where should I be setting my orders if I want to get a purchase in right now, or where should I be setting my orders if I want to sell right now. So with all that being said, that pretty much explains level 2. It's really just a live view of the market and what you may want to set your orders at that instance. So I hope you guys did learn something in this lesson, and I will catch you guys in the next one. All right, guys, so just as we talked about in the bag holding lesson, this time I want to talk about averaging up versus averaging down. You'll see a lot of people say that you should just average down. You never want to average up. And there is some math around that in the fact that, technically speaking, the lower it is, the less it has to continue going down. But in the case of the stock market, generally things are never going to go to zero, so that's never particularly the case. But, people will say, it's not going to go any lower here, and then they'll average down, and then they'll average down again. And what I mean by averaging down is, say you bought 10 shares here, and then it went even lower. At that point, maybe you buy another 10 shares at a lower price. That means now you have 20 shares and the average price is lower than your initial price. Averaging up would basically be the opposite. If you bought shares here and then it went up some right here and you bought more, now your average price is higher than your initial purchase. So that's really what I want to talk about here, and really just give you guys the main tip that you probably do not want to average down. In most cases, averaging down means you are bag holding a stock because it's not done what it is that you thought it was going to do. It has not followed the plan of action that caused you to take that trade in the first place. And if it has not done those things, then you probably should not be in the stock, or you certainly should not be adding more to your position. Now, let's say it does what you wanted it to do. Let's say you bought some right here and it popped up and then it tested this EMA line and it was successful. Now you want to buy more right here. That might be a good idea. In this case, you don't want to, watch it fall, buy some, and then go, oh man, well, it's just so cheap. I'll just go ahead and buy more shares. That doesn't generally make sense because you don't know the future. There's no telling what this is going to do going forward. There's only, pretty much likelihoods and decisions. So in most cases, you are not going to want to average down. You're going to want to be averaging up. If you're considering averaging down, you probably shouldn't be in the position in the first place. So that's pretty much all I've got with averaging up versus averaging down. You probably are going to want to be averaging up, not down. Here and there, you got to make a judgment call. Sometimes it might be worth averaging down, especially when it comes to swing trading. If you are swing trading, then I'm not nearly as big of a average up guy. In fact, I will rarely average up when it comes to swing trading. I oftentimes will average down when it comes to swing trading. But when it comes to intraday trading, if I'm going to average down, I probably shouldn't be in that position. So I generally will only average up when it comes to intraday trading. So with all that being said, that's everything I've got in the averaging up versus averaging down lesson. I will see you guys in the next one. What's going on, guys? Welcome back to the next lesson where we're going to be talking about the bull and bear pennant. So I have this little graphic here that kind of explains what it is and kind of gives you a visual. And after this, we will go ahead and get into the actual software and try to find some examples of this. So what's going on here is very similar to the bull and bear flag, except for it's a pennant. And there's pretty much only one, key difference here, and that is that volatility is huge. It shoots way down on the bear, and then it shoots up and recovers a little bit, then it goes down. But overall speaking, the volatility of the individual stock or ticker or whatever it is that you're trading slowly starts to collapse into a very small amount, and then out of nowhere you will see it just kind of bloop down. or in the bull case, you will see it shoot up and then volatility starts to slow down, and then until it gets to, you know, a very little peak here, and then it will shoot back up again. So that's pretty much the bull and bear pennant. Feel free to take a picture of this. I'm going to try and leave some of these graphics in the course documents for you guys, but now we're going to go ahead and get into some real examples. So this is actually something you can use when it comes to swing trading, day trading, or really anything. This is a pattern that is somewhat relevant. I find it most relevant on a 1 minute, 1 day chart. You know, something like this. So here is kind of a pennant right here. If we look, obviously, like I've said before, you know, these things are never going to be incredibly beautiful. They're never going to look exactly how these graphics look. That being said, you know, this does have the components of one. We shoot up, and then we have kind of this. Obviously, it does break out here, but overall speaking, we do have this little range here that we're forming. And when it came down to actually intraday trading, you know, it was going right here to here like that, and then we get a shoot up, and it goes ahead and breaks out. So that is kind of the elements of a pennant. Like I said, you know, it's not ever pretty much going to be incredibly beautiful. It's never going to look like those graphics. Occasionally here and there you will find an example that's absolutely beautiful, but for the most part, you're not going to see a lot of you know, absolutely perfect pennants, or, you know, even perfect flags or anything like that. You know, these are just general depictions of what you want to look for, but anything close to it, you know, could or could not be considered a pennant. It might be a little easier to find these just for the purpose of examples on the 5-minute charts. So right here we have a little bit of a pennant. If you look here, we go here, and kind of from here, you know, you start to see it kind of consolidate a little bit, and then it pushes up, you know, big, around 7% here on Facebook. You know, that could definitely be considered somewhat of a pennant, but overall, though, I'm not really seeing a ton of examples. This is actually a little bit of one as well. If we were to actually look at this on a, you know, maybe a 4-hour chart, you might would see this a little bit more defined, just because these tails may be a little better. But generally speaking, when you are looking for pennants or things like that, you're going to be looking for, you know, something that was very volatile, you know, now has a big push, and then is kind of consolidating. So something that you might see now that I'm thinking about it is stamps.com. You know, this could sort of be considered a pennant in the fact, especially if we go ahead and look on a shorter chart. You know, we have a big shoot up, and then we start to see it just kind of downtrend some, a little more of a flag at the current look, but at the end of the day, the point is still there. And, you know, if we were to look at this on maybe a 2-hour or a 1-hour chart, this may even be a little more defined. Let's go take a look. Yes, I mean, it's still a little bit more of a flag, but at the end of the day, we are seeing, you know, it was swinging up and down kind of big throughout the day, and then this last day here, it's been pretty tight in trading. The overall volatility has shrunk way down, and in my opinion, you're probably going to see this shoot downward, just because this was such a big move. It's very likely you'll see a break downward on the next trading day, which is Monday as of recording this. You know, that being said, you know, that's just my opinion. That's just one flashlight out of the many flashlights that you should have when it comes down to trading. So take that as you may, but generally speaking, when it comes to pennants, you really just want to go ahead and look for, you know, examples of where something is very volatile, and then the volatility starts to shrink, and the overall moves are not that much while there's still volume. And volume is kind of important, just in the fact that if there's a lot of volume and there's a lot of people trading a stock, but it's still relatively flat, then that means that's kind of an equilibrium point. Equilibrium points are very rare to find, and generally speaking, they are going to break up or break down. It's going to kind of what we like to call snap in a lot of cases is what I would say. You know, it's going to snap up or it's going to snap down. And you'll see a lot of people talk about bull and bear pennants, but I do want to say that from my experience, a pennant is a pennant, and there really isn't a bull or a bear pennant. You're really just looking for a pennant in general, and honestly, what it's going to do in terms of breaking up or breaking down is 50-50. It's going to be different in every case. You know, pennants are not something that I use in a lot of cases, other than just to say, you know, hey, volume's kind of high, volatility is almost none. This thing's going to have a move here soon. But in terms of which direction, you know, I don't know if the direction is going to be up. I don't know if it's going to be down. You know, honestly, you know, whether it came down before doesn't mean it's going to go down in the future. Whether it went up before doesn't mean it's going to go up in the future either. So generally speaking, just look out for pennants in general. I wouldn't worry too much about bull and bear pennants, because just from my experience. I've tried to trade something where I said, oh, this is obviously a bear pennant, and it breaks the other direction far more times than it does the downward section, say if it were a bear pennant. And many times I've traded a bull pennant where, it did this exact thing here. It was a very beautiful pattern, and then it broke to the downside. So, generally speaking, the breakout direction is not going to be able to be determined from patterns, but the idea of a breakout can definitely be determined from a pennant, and sometimes it won't break out at all either. But generally speaking, if the volume is still high and volatility goes down to nothing after being really high, then, that's not going to last that long, and there will be a break, whether it be up or down. That's up to your opinion and what happens in the future. So with all that being said, I hope you guys did get some value out of this lesson, and I will see you guys in the next one. What's going on, guys? Welcome back to another lesson where today we're going to be talking about the idea of sector rotation and flow. So the idea of sector rotation and flow is really that generally speaking, on a lot of days, there's going to be some companies that are down, there's some companies that are up, and a lot of times money is flowing from one company to another, or even one industry to another. So what I mean by that is, if we basically look today, American Airlines is down, Delta is up. So, that's a bad example. However, if we go ahead and look, Wynn is down, Las Vegas Sands is down. And if we go ahead and pull up the SPY over here, this is the overall market. In the morning, it shoots up, pulls back down, shoots up again, pulls back down to this middle VWAP. If we take a look at Las Vegas Sands, they kind of did a similar thing, except for when they pushed up, they didn't push up nearly as much. They did pull down as much. Then they pushed up just a little bit, and then they're back down even more. So the idea here is that, early on in the day, money was coming out of Las Vegas Sands. People were not investing into Las Vegas Sands at the same rate as the overall market. However, if we look here recently, it appears that Las Vegas Sands is kind of consolidating, whereas the rest of the market may potentially be going way down. And what that really means is that maybe some money is starting to shift into Las Vegas Sands. And along with Las Vegas Sands is Wynn, a very similar company. However, in today's scenario, they do look a little different. They're trading quite weak in comparison to Las Vegas Sands. Las Vegas Sands came down here and they're consolidating, whereas if we look at Wynn, let's see, there we go. Wynn is much lower than they were previously and are looking to continue to go down. However, there's going to be some companies that are going to trade very, very, very close to this SPY pretty much constantly. So we might be able to find an example of that here. So, Micron is up 3% while the overall market is only up 1.5. And as you can see, it would appear that there's a lot of money going into Micron as, when the overall market died out in the morning, Micron died out. But then when the overall market recovered back up to where it was in the pre-market, Micron shot way up, way past where it was in the pre-market and is doing much better. So the idea here is that there's money going into Micron. And along with Micron, we have NVIDIA, which is a somewhat similar company. And the same thing is kind of going on here. They shot up a good bit past where they were in the pre-market, especially when you consider here all the way up to here. And if we look at their charts, they do look pretty similar. If we pull up NVIDIA right here, the Micron and NVIDIA chart looks pretty similar. Obviously, in the morning, Micron was a little stronger, and then it died out while NVIDIA had died out earlier and then kind of consolidated. But then at around 10 o'clock, both of these companies shoot way up, and as of recently, their patterns are looking very, very similar. However, if you take a look and notice, it would appear that Micron is starting to look a little bit weaker than NVIDIA, as NVIDIA is currently trading right where it was at this last tail, whereas Micron is a good bit below that at this point. Which, if we look at this list of blue chip stocks that I have here, Micron is at the very top, which means there's a decent chance that some money can go ahead and roll out of that. Whereas if we look down here at JP Morgan, that's the lowest one on the list, maybe some money can roll into JP Morgan and some of the other banks like Wells Fargo and Bank of America, which are all quite low in comparison to the overall market, which is currently up 1.5%, whereas these are down almost 2% or even 1.3 or 0.6 when the overall market is up. So they're kind of doing the opposite of the market. And as the day goes on, you could potentially see some money rolling into these companies and them outperforming the market at that point. And that's really how you go about trading when it comes to sector rotation and ebb and flow, is that, you might be able to take advantage of some companies that are, don't have the money at this point. And that's kind of how I like to refer to it, is the idea that, this company has no money right now. This company's not doing well. Investors are not flooding money into here. Whereas if we go ahead and look at the top, a lot of investors and a lot of money is going into Micron currently. However, just like with regular supply and demand, the likelihood of that continuing to happen is much lower than the likelihood of JP Morgan potentially having some money roll in. Now, you also have to compare this to the fact that, how much money is going in and out of the overall market. If we go ahead and look at the SPY itself, if the SPY is trending down, there's a good chance pretty much everything on this list is going to be trending down. Question is JP Morgan going to be trending down much faster than Micron, or is Micron going to be going up? So that's really what it comes down to, is that you kind of can look at the two opposite ends of the spectrum and kind of compare them and see where you think money might be rolling into. And ideally, you invest when money is going into the overall market and there's money going into JP Morgan, for example, because all morning there hasn't really been any money going in. Once the overall market starts to pick up, JP Morgan might pick up at an accelerated rate in comparison to something like Micron. Very likely, considering they're already up almost 3%. So I hope that kind of explains ebb and flow. It's a little bit of a complex topic to speak about, and it's all theoretical and relative. There are some studies and things like that you can get from other brokers that will kind of show you the actual flow that comes in and out of a stock. I don't generally mess with any of that. You can usually just kind of tell when it comes down to just looking at watch lists and things like that. But that's really the idea there, is that money is going to flow into certain companies and, more importantly, certain sectors. And when it does, a lot of times it's going to be flowing out of other companies and sectors. So right now, Micron and Nvidia, as we've been recording this video, have both fallen about 0.5%, while the overall market has been somewhat flat. I mean, it's still at 1.5%, so it's lost maybe 0.1%, but Micron and Nvidia have lost over 0.5%. So, money might be shifting out of the chips, while maybe some money is shifting into, maybe the casinos like Wynn and Las Vegas Sands. In fact, I think Las Vegas Sands is actually doing pretty well as of the last second or two. Yes, I mean, they're looking pretty well. They've, consolidated here, and they just got a big shoot right there. There's a decent chance that money is going to start flowing into Las Vegas Sands, and as it does, some money is also likely to flow into Wynn. Just because of the current prices, I would say that it is more likely that more money is going to flow into Wynn than Las Vegas Sands. That being said, as of right now, Las Vegas Sands, they've had a little bit of a tear, and they're doing a little bit better than Wynn as of right now, but Wynn did just turn green. So, this is the exact move that I'm kind of talking about, and really the idea that, these companies, and this is the exact move that I'm talking about. Money is flowing into the overall market. All of these companies are going up, but these companies that are down on the day, or these individual sectors like Wynn or the banks or things like that, are more likely to recover quicker and add more to their gains than companies that are all the way up here. Because what's realistic? I mean, you have potential for Wells Fargo to add 1.5%, but is Micron really about to go up to 55? Or, what would it be to go up another 1.5%? They're likely to shoot all the way up to here. That's pretty outside of this top VWAP line. It's somewhat unlikely. It certainly could happen, but much less likely than, Wynn to just recover back up to, 104. That's somewhat likely. That's, within today's range and certainly doable. So that's really the idea, is that you can kind of look at two charts and kind of see, okay, money's going into the overall market, and it appears that more of it is coming into this sector or this stock right now than some other sectors or stocks. And that's part of the reason I wanted to record this video during the actual market, is so that we could potentially get an example like this right here, where we're starting to get a reversal here. And if we look over here, the actual overall market is trending down as of the last minute, and it appears Wynn is still pushing up. So, you can take advantage of short plays like this throughout the day. And, it's very useful for day trading if you are trading blue chip stocks. And it's also incredibly useful if you guys are trading options. I have an entire course on options on Skillshare, so if you guys want to check that out, you can. But yeah, so with all that being said, I hope you guys did get some value from this lesson, and I will catch you guys in the next one. What's going on, guys? Welcome back to another lesson, where today we're going to be talking about the midday lull. So that's what I like to call the time in which you're not really going to want to be taking a ton of trades because volume is so low, and it's perfectly displayed pretty much almost every day. It's going to be a little worse here recently, just because volume on the overall market has been about 3 times what it normally is. But I actually probably can go back in a second to a time in which that was not the case. But, this right here, we open up in the morning, volume's high, it shoots down a little bit, then it shoots way up on, I believe this was a Fed announcement, and then it comes back down. And then I imagine there was something here that, or a lot of people just saw value at this price point, and, more people were buying. And then all of a sudden it kind of fizzles out. So, if we look down here, the volume's quite low until about 2 p.m. It starts to pick up again. And then right at the end of the day, it shoots up yet again. So I'm going to scroll all the way back and show you guys a probably better example of this. Yeah, so this is a pretty good example here. Volume shoots up in the morning, right at the open, and then it kind of fizzles out, shoots up here, but overall it's fizzling out. And then, throughout the day, usually starting at around 11:30 or so, volume goes to almost nothing, and it really doesn't pick back up in this case until almost 3 p.m. And then it usually shoots up right at the end of the day. So if we go forward and take another look here it is again. The volume's pretty high in the morning, and then it kind of fizzles out to nothing at around 11:30, sits there until around 2:30, 3-ish, and then it starts to pick back up again and shoots way up at the end of the day, and that's pretty much it. Now, the reason this is important is a lot of times you're not going to want to be trading in this time period just because there's generally not any big moves. So obviously with the overall market, there's some moves, but especially if we look at any kind of penny stock or something like that, you're oftentimes not going to find a lot of opportunity in days like this. So, if we go back and look, so, here we are on AT&T stock, volume's kind of high, fizzles out, and then more importantly, starting at about 11:50 or so, all the way until around 1:30 or so, this stock does pretty much nothing. It just sits here, does absolutely nothing. There's no advantages there. You can't really trade that, and you're probably just going to give yourself anxiety just sitting here staring at it if you were to take a position on that. So here's another example on Delta Airlines. The stock's moving up in the morning, volume's kind of high, and then at around 11:50 or so, this is when a lot of people go to lunch in New York, and that's part of the reason. But at around 11:50 or so, volume starts to go way down to almost nothing, and then pretty much throughout all the way until around 2:15, 2:30 or so, not a lot happens with this stock. Especially right in this period, nothing is happening. We're talking about 0.1% moves over the course of over an hour. This is pretty useful when it comes to saving yourself time, because there's just no point in sitting here and staring at a chart for 2 hours when really nothing is happening. And this happens pretty much every day. Obviously there are days here and there where something's going to be incredibly volatile all day. In this case right here, this is yesterday, there are some potential moves, especially if you were trying to go short on this. There are some potential moves you could have taken on this day, but the volume is also much higher on the overall market currently than it normally has been. So that's really what I wanted to explain in this video, is that around 11:30 to 12-ish is when people go to lunch in New York. Volume on the market falls, and there's really not a lot of opportunities until around 2:30 or so in the afternoon. And if you're sitting here staring at the markets, you're probably just going to give yourself anxiety, and there's really not going to be any trades that you'd want to take anyway. So with all that being said, I hope you guys did get some value from this lesson, and I will catch you guys in the next one. What's going on, guys? Welcome back to another video where today we're going to be talking about morning washouts and dips. So I actually just fired up the software and I actually found this example right off the bat. I believe this is from yesterday. Yes, it is. So, this is a pretty good example. I haven't even looked for any other ones. This was just right here. So this is General Electric's stock. And throughout the morning, we were trading downwards, and then we kind of slowed off on that and, mostly stayed pretty flat throughout the early morning. And then we shoot up a little bit to this top resistance here right at the open, and then boom, right at the open, we shoot way down. Let's see, almost 5%, which is pretty volatile. That being said, General Electric has gotten a little volatile here recently. And this is a perfect example of what I would call a morning washout. It's kind of the opposite of a parabolic short, but it's basically where, right at the open, you're going to see a shoo down. And once that happens, there is an opportunity to go ahead and purchase down here, just because, this has fallen to a over-exaggerated rate, and, definitely shouldn't be this low at this time. And, you can go ahead and purchase these shares somewhere in this area and then maybe cap 1-2% in profit. Obviously, if you're trading options or something like that, then there's going to be more margin there. But, this is really the idea of taking advantage of an exaggerated move to the downward side. Usually these present themselves at the open. They're going to be much more relevant and you can really look for them, and they're more likely to happen right at the open. Obviously, throughout the day, there are other scenarios of this, like right here, but generally speaking, throughout the day, it's not as much of a safer play in terms of buying the dip, just because, you know, especially if we just look at this example, you know, if you bought the dip right here, you still lost a lot of money unless you rode it out for the rest of the day and maybe got out like right here at the very top. You know, you still lost money. And this happened right at the beginning of the day, but sometimes in the morning, in fact, I would say most of the time in the morning, right at the open, if you see something like this, then it's likely going to recover at least some. So I'm going to go ahead and look for a few other examples, but this is really the idea of taking advantage of an overhyped move to the downside, usually right at the morning open. So here's another great example. This is on Alibaba stock the other day. I'm not exactly sure which day this was, but we're trading up in the morning. All of a sudden we shoot way down, and then we have a little bit of a push up, and then we, you know, kind of taper off a little bit, but then we have this big move back up pretty much to where we opened at in the morning. So, you know, if you can get into this stock pretty much anywhere in this area, I'm going to draw it out real quick for you guys. If you can get into this stock pretty much anywhere in this area right here, you know, you still end up in the profit. If we go ahead and calculate the margin, say you even got in like right here at this price, you know, you still, and you get out right here, you're still up 0.8%. And if you guys are trading options, then, you know, the opportunity there is probably 10, 15, 20%. Obviously, that does carry much more risk, but, you know, this is really the idea of taking advantage of these overhyped moves like this one right here. In terms of what happened right after, you know, this isn't the most beautiful scenario. So, you know, this is exactly what you want to look for, is just, you know, right at the open, something just washing all the way out and just falling a ton, and kind of in a lot of cases doing the opposite of what it was doing in the previous day or, you know, earlier morning. So, I mean, this was really bouncing here and here, and then all of a sudden at the open it shoots way down, consolidates ever so slightly right here, and then continues to push down. At this point, that's when I would have called this a little bit of an overhyped move, especially when you take into account sector rotation and you know, say the overall market was not doing this, say the overall market was kind of tapping out here and kind of chilling, then you know that this stock is quite weak in comparison and is likely to recover as it did right here. So this exact morning, I actually think there was a Fed announcement right here, so that's a little bit of the explanation for this. But I do know that the overall market wasn't, you know, trading exactly like this either. So, you know, this stock I would say was definitely weak in the morning, and, you know, that presented some opportunity later on to go ahead and cash out maybe 1% or so. And if you're trading options, then that's much more. So here's a little bit of another example. Definitely not as good of an example. This is a little bit more of a flag in my opinion, but, you know, we're trading up in the morning. Right at the open, we start to turn downwards. We move down quite a bit. We consolidate, build a little bit of a resistance and a little bit of a flag here in terms of, you know, this shooting up like this. And then, you know, say you got in like right here on this break, you know, you're still looking at 1.4%. This is on TQQQ, which is a 3x leveraged ETF. So, you know, this is where you're going to see a little bit more margin. You know, if you were to buy right here and write it up here, that's almost 5%. That's a whole lot more than you're generally going to see from an individual stock or something like that. So that's really the idea behind morning washouts, is just this drop straight out of the open. Here's a little bit of an example, definitely not as good. This is actually the exact same day as that, I believe, BABA play that I was just showing you guys. You know, we shoot down in the morning and then boom, we got a big push up on the Fed announcement. Obviously, you couldn't know the Fed announcement, but this should follow the overall market. So, you know, taking that into account, we definitely do know that that BABA position that I showed you guys was very weak in comparison, because when this bottomed out right here for a little bit, that BABA position was way down here. So, you know, that definitely was weak on the morning, and regardless of the Fed announcement, that likely would have been a good trade. So that's pretty much everything I have to go over in this video. If you guys have any questions, be sure to let me know on Instagram or YouTube or anything like that, and I will see you guys in the next lesson. What's going on, guys? Welcome back to another lesson, where today we're going to be talking about trading the news, reports, and things like that. Things are going to be catalyst for the stock market to move, or, you know, individual sectors, or, you know, specific commodities. So first off, this example just happened the other day. So right here we had a Fed announcement. This was an emergency announcement, and that's what kind of shot the market up a little bit. You know, this was an emergency one, so it was a little bit unanticipated, but generally speaking, the Fed does have a calendar that you can watch and keep track of, and that's really going to have a big effect on the market, you know, similar to this, where, you know, it just shoots way up in a matter of seconds, and it comes back down to parabolic shorts and the washouts. Is, you know, while this doesn't happen right at the morning, generally news items like this are going to be able to be traded, and this is a perfect example. This shoots up huge within a matter of literally 1 minute. The overall market probably shot up about 2% on this. We can go take a look actually. Yeah, so right here, this is the actual market. So if we just do a calculation here, the overall market shot up 2.24%, give or take, in the matter of 1 minute, and then it comes back down. And the reason for that is this is an overhyped move. It happens almost instantly, and it's more likely that it's going to pull back and recover a little bit before it continues to push up. Now, in this individual case, it still did not actually push up. It just pulled back some and then consolidated and then pulled back down even more. But generally speaking, these are the moves that you're going to want to take advantage of when it comes down to these anticipated reports. So every single week, there's a report on oil and natural gas. I'm going to go ahead and start off with the oil report here. So this happens on a Wednesday, which is, Wednesday. So right here, these come out at 10:30. So 10:30 is right here. I didn't really see a lot happen this week. I'm not really sure why nothing happened on this specific report, but there really was not anything special happening. So what I'm going to do is go on back to the previous week when there was another report. Yeah, so right here there was a report released at 10:30 right here, and then we see a huge volume spike, especially from the previous minutes. The volume was right around in this area, even dipped all the way down to here, and then as soon as this report comes out, volume shoots up a ton. The move itself wasn't incredibly drastic, but the volume did shoot up a ton. The moves are generally a little bit more prevalent when it comes to natural gas, so I'm going to go ahead and pull that up over here. And if we go take a look at Thursday, which is when those reports are released, and we look at 10:30, which is right here, we're going to see 10:30, the report shoots this kind of up, and then it actually winds up coming back down. So when the reports do something like this, there's not a lot of opportunity just because it's kind of moving in and out. But a lot of times there might be a huge move to the upside or a huge move to the downside, and these are very easy to take advantage of. It really doesn't take a genius to trade these and make money. So if we go back and look at another week, let's see here. So this is Thursday. This is a good example. This might be one of the best examples I've seen in a long time. Market's trending down. That's generally not something I like to see when this happens, but in this case, it did work out. 10:30 comes, volume shoots way up, all the way up to here, whereas previously it was right around this area. The actual natural gas shoots down almost 1.5%, consolidates for a bit, and then trends back up higher to where it was right before the report. So if you can buy this somewhere around this area, or even when you get this bounce back above this EMA line, say you get in right here and then you ride it up to right here, you get out. That's 13 minutes, you make 0.75%. And if you're trading a 3x ETF, then that's close to 2% or so. I guess it's 2.25%, I believe. That's a very solid amount of money to make, in a matter of 13 minutes. So, this is the opportunities that you want to take advantage of when it comes down to trading news or reports. The natural gas and oil reports I trade pretty much every single week, and then a lot of times I will trade a Fed report. But generally speaking, these are something that I'm up every single Wednesday and Thursday waiting for these reports, just sitting here, just waiting to take advantage of the potential opportunity. Obviously, sometimes I do that and it's kind of a waste just because the stock just kind of teeters in one spot and doesn't do anything. But a lot of the time you will see a move either to the downside or to the upside. So right here, this is the previous week from that one. So I believe we're 3 weeks back from today's current date maybe. And right here at 10:30, the volume spikes up, the futures go way up, and then they kind of flatline. This is a little bit of a weird report, and this is something that you probably would not have wanted to trade, and this honestly might have been something that you lost out on if you did trade. That being said, this big of a move, this is something that you might wanted to, wait out on for an hour or two and then trade it up here on an inverse ETF. So, on an inverse ETF on DGAS, for example, this is basically going to look the opposite. So it's going to be trading up. Then when this shoots up, this is going to be down. And, so right here, that ETF should have been at an all-time low for the day. When this whole move down happens throughout the day, you can take advantage of that because that ETF will be moving up. So that's really the opportunities that are presented within natural gas and oil, in my opinion. There's plenty of other futures that you can trade, but these are the ones that have reports every single week that I trade, and I'm a huge fan of, and I think honestly are probably one of the easiest ways to get into trading and actually becoming profitable, just because it's very obvious when something is an overhyped move, and probably doesn't make a ton of sense. So, but in the case of this, this was definitely a weird move, a little bit of a fluke in the fact that it shoots up, flatlines, shoots up again, flatlines, hits another new high. This is a little bit of a strange day. That being said, right here when it consolidated and didn't really move down, this could have been an indication, especially after hitting a new high right here. This could have been a good trade right around here to go ahead and get into, and the opportunity is pretty big. If you're on a 3X ETF, you're looking at 6% up to here. Now, me personally, I probably would have got out around here, right when we started having these red candles, so that's only about 3%, but I like to play it safe rather than sorry, as we will talk about towards the end of the course. Yes, I just wanted to highlight the fact that it's very hard to trade news. A lot of people will try to trade news on the fact that 3M announces X, and all of a sudden they want to go buy this stock because of what they announced. But the thing is, a lot of times that's already going to be factored in pretty much instantly. That being said, many times it can be irrational, as you can see in this case. This move right here is insane. So you really just want to look for these very irrational moves, things that just don't make sense, and that's generally where you're going to be able to take advantage of something and make an easy profit, really without doing a lot. So with all that being said, I hope you guys did get a lot of value from this lesson, and I will see you guys in the next one. What's going on, guys? So in this lesson, we're going to be talking about futures, 3X ETFs, as well as the inverse version of those. So right now I have the natural gas futures pulled up, and this is essentially the value of natural gas over, I believe, the last 20 years. Yes, so this is about 20 years worth of natural gas charting. And we're going to see that, this is mostly pretty up and down, right? However, if we go and take a look intraday at this ETF that I like to trade, it's called UGAZ. This is a 3X leveraged natural gas ETN, okay? And what that essentially means is that whenever natural gas goes up 1%, this is going to go up 3%. If natural gas goes down 1%, this is going to go down 3%. So it essentially accelerates the profits and losses that you could make. Now, I personally love trading these. These are my favorite things to trade, but there's pretty much no way to invest in these. And the reason for that is due to this thing called beta decay. And what that essentially means is that because this is an ETN, which stands for exchange traded note, there's no actual asset behind this. So if this is at 100 and it goes down by 1%, it's at 99. Now, let's say this goes back up by 1%. It's actually not going to be at 100 again. Okay, so 1.01, it's at 99.99. So basically, when oil goes down 1% and then it goes back up to 100, the amount that it goes up is based on an asset. It's going to go up a little bit more than 1%. But because this ETN doesn't have any true assets, it's actually just linked directly to that future. This is only going to go up 3%. So 97 times 1.03 is going to give us 99.91, not 100. And the reason for that is beta decay. And it's essentially when you subtract an amount and then you multiply it by the exact same amount again, it's going to go down just a little bit because it's multiplying against a lower base. So in this case, it goes down by 3% against 100, but then it only goes back up by 3% against 97, which gives us 99.91. So that's basically beta decay for you. I hope I explained that, but it's very obvious when we go ahead and look far out. If we look at DGAZ on a 3-year chart, this is the chart. So you can't even really see it. If we go look at it on a 1-year chart, it's constantly going down. Even though this should pretty much mimic natural gas, if we go look at natural gas futures for the same time period, we're going to see that they're, for the most part, kind of flat. Okay, they're certainly down, but if we go look on the 3-year chart, we're going to see natural gas is pretty flat. Whereas if we go look at it on UGAZ, we can't even see the chart. And if we scroll in, you still really can't see. And it's because it was all the way up here at 3,000 right here, and now it's at 29. So, the price difference is so big. When it was right here, it was at over 1,800. Now it's down to 29 currently, or 44 actually, but a low of 29. So that right there basically explains beta decay for you. These ETNs, because they don't have assets, are going to overall go to zero. They always go to zero. There's no way to get around that due to beta decay. Regardless of this though, this is definitely something that you can go ahead and take advantage of. What I usually like to do is in the morning, I like to keep this chart on natural gas. So I'm watching the futures directly. And futures allow you to actually watch it overnight and in the pre-market much better than the actual ETNs do. But if we go ahead and look here and we look at just during the day and just during the day, you're going to see that the actual charts are very, 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 very similar, pretty much the exact same. So if we look, we had a high here, we had a high here. Flat up, high here, shoot down, high here, shoot down. These pretty much are going to look the exact same, but this ETF is losing a little bit of its value every single time it makes a move, and over time that value does make a big difference. If we look on the 3-year chart, or if we even look on the 1-year chart, it's definitely decelerating at a much greater pace than natural gas itself has been doing. And that's especially prevalent right here. We see that back in 9/16, this was at a new high, and then on the ETF, 11/6, this was actually lower than it was on 9/16. However, if we look at the exact same dates on the actual futures, it was higher on 11/6 than it was on 9/17, even though on the ETF it was higher here and lower here. However, these are definitely one of my favorite things to trade. They have reports every single Thursday at 10:30 a.m. There's often some very good opportunities that you can go ahead and take advantage of, but you just want to keep in mind that long-term investing in these, or really anything aside from day trading in these, is probably not going to work out well due to the beta decay. So just keep that in mind. And aside from that, that's really what I wanted to explain here, is that there are futures and there are 3x ETFs. There's also a bear version of this, which we'll talk about for a second here. This actually does the opposite. So I'm going to pull up UGAZ up here. If we look, UGAZ hit a new high right here on the day. It hit a new low right here. This steep sell-off right here on UGAZ was a steep push-up here on DGAZ. This is pushing up in the morning. This is pushing down in the morning. So these charts are pretty much the exact same thing, but they are opposite of each other. So if you think natural gas is going down, what I will usually do is keep the natural gas futures right here. If I think this move right here is going to happen and I think it's going to go down for whatever reason, then on DGAZ, let's see, this is about 12 o'clock, then I could invest in DGAZ, and DGAZ actually pushes up at that time. So that's really the value, is that you can really make money when it goes up or down with these 3x ETFs. And because they are 3x, natural gas only had a 0.66% move here. But if we go ahead and look at UGAZ, that was probably close to a 2% move. Let's take a look. Almost 2%. So that's pretty much the value of this. The actual move there should have been about 2.25, give or take a little bit due to beta decay. But generally speaking, these are going to move pretty much the exact same. And, if you think natural gas is going down, then you could buy DGAZ. And if you think it's going up, then you could buy UGAZ. And, it's a very easy tool to trade with. It's one of my favorite things to trade. It's what I trade primarily, is natural gas and oil. Sometimes I'll trade some gold, but I generally stay away from that. But there are futures for pretty much everything, and there are bull and bear ETFs for pretty much everything. There's soybean futures, there's cattle futures, there's pretty much futures and ETFs for almost any kind of commodity that you could think of. But natural gas and oil are generally my favorite things to trade. And that's what I generally stick with. But, if you wanted to trade cattle futures for some reason, then you could go ahead and do that. I'm sure there's an ETF out there for it. So with all that being said, I hope this lesson was helpful, and I will see you guys in the next one. All right, guys, so I wanted to make this quick lesson to show you guys TraderSync. Now, the real purpose of this is to explain to you guys the actual value of going ahead and tracking your trades. That way you can go ahead and see, what times are you most successful? What times are you not successful? If you find yourself that, at 3 p.m., every single trade you ever take, you wind up losing money on. And at 9 a.m., 75% of the trades you take, you start making money on, and it'll give you your average returns and a ton of things. This does cost money. So if you guys don't want this, I would still highly recommend that you just get yourself a notebook for like $2-3 and just write down certain data. Write down a trade that you took, write down your profit loss, total invested, as well as the time of day in which you took it. That way you guys can go back and take a look, and just see if there's any patterns within your trading, and see if there's anything that you potentially failed on or you potentially were successful at. And as they have here, they have setups. You might want to write something like that down. What was the reason for taking this trade? I'm not saying to do this forever. I don't do this anymore, but I did when I first started, and I think it really helped me out a lot. So I would highly recommend doing that. I'm not even sure how much this is. We can go ahead and look at pricing. So I guess they have a basic. I'm not really sure what that is, but it's $30 a month. I imagine you don't need the premium or the elite. So if you don't want to write it down and you just want to do it very quickly, then $30 a month gets you this. I guess free actually gets you all of this. So I mean, yeah, you could use this completely for free instead. And then if you wanted the pro version, that gives you much more data. And then obviously there's the premium and elite. I don't really think you need this. Yeah, I don't think any of this is that worth it. Commission and fees tracking, most brokers are free. I would 100% go with a free broker anyway. So just go ahead and try this out. The free version should do just fine. Maybe you want to invest in the pro version if you're balling out over there. But as far as I'm concerned, the free version should go completely fine. But if you don't want to mess with this, or you don't want to give them your info or anything like that, then you can definitely just go ahead and get a notebook and write down your potential strategy, when you're making mistakes, what mistakes you're making, what time of day they're happening, and things like that, and kind of get an idea of what it is that you're doing wrong and stop doing that, and get an idea of what you're doing right and continue doing more of that. Trading is just like any other business, in the fact that, there's a lot of trial and error and seeing what's working and what's not working. And this is going to be a very important way to go ahead and do that. So with all that being said, I will see you guys in the next video.
All right, guys, thank you for checking out this course. I do appreciate it a ton. If you guys have any questions at all, feel free to inbox me or go ahead and hit me up on Instagram at David Eves Official. I've replied to pretty much every single message I get there. And if you guys need any additional help or anything like that, you need a consulting call or you have a question or anything like that, ask me on Instagram and I can set up a call with you guys and we can go over some things in more detail that I may not have explained entirely perfect in this course. Because at the end of the day, you guys did spend your time watching through this whole course. So, if I didn't cover anything, then I definitely want to go ahead and make all of you guys as happy as I possibly can. And with all that being said, thank you for checking out the course. Be sure to check out my YouTube channel, youtube.com/David Eves Official, and I will see you guys later.